scheduled a virtual summit next week to discuss President Trump's tariff. They're rallying support for multilateral deals on trade now. Joining me now is Blue Chip Daily Chief Technical Strategist Larry Tentarelli. Larry, good to see you. Thank you so much for being here. Before we get to the fundamentals of all of this trade talk going on, I want to get your thoughts on what's most compelling to you. You're looking at technical strategy and the charts, and you say J.P. Morgan is breaking out right now. Tell us why and what you see in this chart.
Yes, good morning, Maria. So J.P. Morgan is the leader in the financial sector, and it's really a bellwether for the economy. It's breaking out to new all-time highs. I believe it's in anticipation of the Fed rate cut. The markets have priced in about an 86% probability that the Fed's going to cut rates on September 17th. And if so, the cyclicals should perform well, especially the big banks and brokers. J.P. Morgan's breaking out. Goldman Sachs is making new highs. Morgan Stanley. This is a very bullish group technically.
Yeah, and the stock is all the way up at 301 and change right now on J.P. Morgan. So you think this indicates a breakout for the banks ahead of a cut in rates in September?
Exactly, yes.
Yeah. Yields this morning are bouncing. Look at where the 10-year is right now, Larry. It's up 6 basis points as gold hits record highs, extending gains for a sixth session in a row. The yield on the Treasury is up 5.7 basis points. Investors are waiting on a fresh round of labor data this week. We'll get the July JOLTS report out tomorrow, the August ADP number out on Thursday, and then the August jobs report on Friday. Economists are expecting 75,000 jobs created for the month, with the unemployment rate ticking higher to 4.3%. What do you make of this bounce in the yield on the 10-year this morning?
We should expect a lot of volatility and wide trading ranges in bond yields, in the bond market, in equities. This is a very headline-driven market environment right now. The market is not 100% convinced that the Fed's going to cut rates in 2 weeks. They're mostly convinced, but not 100%. It's not a guarantee, and I expect that you're going to see volatility in bond yields, in commodities, in equities based on all of this incoming economic data. As you said, we've got jobs report this week. Next week, we've got PPI and CPI. And then in 2 weeks, we've got the Fed meeting. So in the short term, we should expect that any outlier in this data can lead to wide trading ranges in many markets in either direction.
Yeah, I mean, that Federal Reserve policy meeting is happening in just a couple of weeks right now. Investors are widely expecting a rate cut. We've got the majority, when you look at these polls, in terms of a cut. Based on that last Fed meeting, are expecting rates to come down. But it was interesting that Jay Powell said not necessarily a string of rate cuts. Don't expect a complete pivot in terms of lower rates. Maybe that's what's sort of, confusing investors.
I believe so. And what the problem is right now is inflation is still sticky. So the Fed's official target is 12-month PCE at 2%. It came in this past Friday at 2.6%. We've had a few hot CPI and PPI numbers. So although the Fed is most likely going to favor weak labor market data, the inflation data really does not support a rate cut. And I believe that's what the uncertainty is in the markets right now.
I see. What about big tech? You also said that Alphabet is breaking out, Larry. Are you looking at that chart?
Yes, very strong. So Alphabet's breaking out to new highs. They had a very strong earnings report. And what you're going to find is that these big tech charts, they're pulling back a little bit right now, but they had very strong quarters. Microsoft made new highs, Meta made new highs, and big tech should continue to perform well through the end of the year.
So would you keep buying big tech here?
Absolutely. I would buy it here. If we get any seasonal weakness in September, if we get any volatility into the Fed meeting, I'd use that as an opportunity to add to some of these high quality big tech names.
Yeah, I wonder what higher rates does for that, because Greg Farinelli, jump in here. You've got the 10-year yield right now hitting the highest level since July, even as the market expects rates to come down. Gregory.
This has been the challenge in general. If you look at the last rate cutting cycle from the Fed, short end rates came down, but long end rates went up. So the market is still very nervous about the long end of the curve in general. When you look at Fed independence, where you look at that being priced, it's being priced on the long end of the curve in general. So short end rates are fine. The administration wants 10-year rates lower. Unfortunately, they don't control 10-year rates, and this continues to be the challenge here, I think, going forward. 25 basis points here is not going to make a difference. If you really want to ratchet down long-end rates, if you want to ratchet down long-end rates, you need to bring the entire curve down by 100 to 150 basis points. And I don't see that in the picture anytime
soon. That
is
a great point, Gregory. Larry, what about that? Real quick, we got to jump, but are you expecting 25 or 50 basis points in the meeting in 2 weeks?
I'm expecting 25.
25. So Gregory just says that's not going to do much. Larry, it's great to get your take on all of that. Thanks so much.
Thank you, Maria.
Gregory, Larry, thank you. Stay with us. Quick break, and we've got a lot more ahead. Stay with us. We'll be right back on Mornings with Maria.